Hello everyone. Let me first wish you all a very happy new year. To start with 2018 outlook, I want to draw reference to what actually transpired in 2017. So I actually tweeted on the last day of the year which basically summarizes the mood of 2017, wherein as an asset class, equities were in a rocking mood, whereas fixed income investors had to brood, and gold movements have had most of the participants rude. Now what I mean by that is that the last year, which is 2017, was a little bit somber year from a fixed income investing standpoint. Liquid category funds were the best performing category, while bond and dynamic bond and gilt funds category returned sub-liquid category investments for the year 2017. Credit accrual funds and bond short-term funds still managed to hold afloat. They were quite, I would say, head high and ended the year fairly well. What really materialized was over 100 basis point jump in interest rates, and this is despite the fact that we saw a 25 basis benchmark rate cut in the middle of 2017. Is this mood likely to linger around? What does 2018 have in store from a fixed income standpoint? I think for that it's very critical to note what are these, I would say, the pillars based on which we could make certain assumptions. So for starters, we've already seen an announcement of an additional government borrowing program for the financial year FY18, which ends in March of 2018. Now that means additional 50,000 crores of supply on dated government securities, which means incremental supply of government debt on a week-on-week basis. This is clearly a negative from a bond market perspective. Second is, we are also seeing a tightness in liquidity, because of which the short-term interest rates have inched up anywhere between 25 to 50 basis points. Will this linger around? Our sense is that it could be there for maybe a month or so. After that, we could see liquidity gradually coming back into the system. Third, we have seen a sustained increase in crude. Even in 2017, crude was up almost 14%, and the innings of the new year also has begun with a slight upward movement on crude. Now crude, will it be a rocket star or a rock star? By rock star I mean, will it start easing out, giving markets some positive vibes, or keep rocketing up northwards and create pain points to the market? That is going to be a very critical driver for rates going forward in 2018. We believe for now, crude is likely to remain range bound and not really look very ominous from a market standpoint. However, the fact that it has started inching up may not give a very palatable feel for investors investing in bond markets in the very near term. Second, the budget will outline the fiscal deficit for financial year 2019. Will the government continue to walk the talk of fiscal discipline, or do a repeat of what has been done for FY18? I think that also will create its own pangs of uncertainties. Last but not the least, foreign institutional investors had record flows into Indian fixed income and in Indian equities this year. Out of the total about 1,91,000 crores, a predominant amount of over 1,30,000 crores actually came into Indian fixed income. Can that momentum sustain? Yes, but subject to limits being opening up is also going to be a critical wait and watch. So if we blend all this into a blender, what do we get? The fact that bulk of the negatives have already been discounted into the current prices. Yields at elevated levels are looking very attractive for foreign investors, especially when our dollar rupee has been behaving itself, is creating a pitching ground for investors to take meaningful exposures into fixed income at this juncture. What would you do as a domestic investor at the current juncture? There are two ways to look at it. One, if you would want to take a call that at 7.4 levels on the 10-year benchmark, put in monies at this point in time and hold it on for the next 3 to 5 years could be one potent strategy. Second is stick to the simplistic, I would say stable kind of a portfolio regime and stay put into credit stroke accrual based strategies. That could be the second alternative. We believe risk reward at this juncture, also keeping into mind the stability that is desired from a fixed income portfolio, investors could still look at core allocations to a combination of short-term stroke accrual strategies and continue to have a top-up into gilt stroke dynamic bond funds. Do we therefore believe that interest rates will keep cascading one way downward or continuously upward? The answer to both of them is in the negative. We believe that the volatility that happened in 2017 probably could continue itself well into 2018, and therefore a core allocation of stable bias and a fringe allocation with an objective of extending duration could be the desired port of call. Very near term, interest rates could stabilize, the key factors determining the future course of direction in terms of interest rates. I think it's very, very critical to maintain the discipline of asset allocation and B, having asset allocated, have the patience to live through the investment tenure, which is why the roller coaster of any asset class has to be lived through its uncertain and volatile times. On that note, once again, wish you a very happy 2018. Hope you have a cheerful investment year ahead. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.